We saw a sell-off after that GDP report yesterday. Give me a sense. It came after weaker than expected GDP, which is kind of counterintuitive to the way we've seen economic reports work in recent weeks. It has been the trend that the hotter report leads to the sell-off. Were you surprised by this at all? Or in your mind, is it just part of that seasonality that you see during an election year? You gave us a chart that shows during the months of April, May, and June, there's just historically some seasonality.
Yeah, Frank, good morning. Thanks for having me back. I mean, listen, after a 30% rally, right, that we had over the past year, the huge rally off the October lows, you look, some indigestion made sense. And in an election year, like we just said, April, May into maybe early June tends to be kind of weak. Then you get a surprise summer rally most election years. So just be aware of that. But looking at that GDP, as a lot of people talked about yesterday, consumption was still strong, right? Investment was still strong. The parts that matter for the economy were good. It was because inventories and exports took away over 1% of GDP. So listen, you can slice and dice it all you want. We weren't overly concerned. What clearly upset the apple cart, though, was the inflation data. Now, that's quarterly PCE, like you just mentioned before I came on. Monthly PCE comes in later today. And just to put a bow on this, when you look at that quarterly data, I work on financial services, right? Most of the guests work on financial services. Financial services, fees are higher. Why is that? Because the stock market did great last year. That was a big reason why the quarterly PCE yesterday, Frank, was a little hotter. So we're anxious to see what today is. We think disinflationary trend is still in play. Yes, I know the last 2 months been a little rocky. We think today could be some good news, and the market kind of looked past that GDP number and realized, hey, earnings season's still been pretty good. And you got to be impressed by that reversal, because 24 hours ago, things were pretty ugly. Now we're doing a little bit better, and that's something.
Yeah, I mean, earnings season has been very strong, to your point. Sophie, coming over to you, GDP, it appeared in some ways to show the impact of higher rates on the economy and leading to a bit of a slowdown. In your mind, that GDP report, does it have any read on the mega cap tech trade? Obviously, right now we're seeing the markets move higher on reports from both Alphabet and Microsoft.
Yeah, sure. I mean, look, the macro picture is always going to affect super growth stocks like this. However, what I would say is the effects of things like this are more muted than they would usually be. The market is far more interested at the moment with those outlook statements and with the pure play individual stock stories and the growth outlooks and the runway for AI. So yes, it does matter. If we see some dramatic moves in either side with the macro, yes, that will affect appetite for growth broadly, growth stocks, that is. However, the impact of the macro is a lot more diluted than we've seen in previous times.
I want to go back to that GDP, just one data point in there. Business spend, that actually accelerated. It was up over 3%. At the same time, Sophie, we're seeing Microsoft and also Alphabet increase their CapEx quite considerably. Microsoft increasing their CapEx by 80%, Alphabet by 91%. Just a day ago, Meta got dinged for that. Why do you think that Alphabet and Microsoft were actually rewarded for these huge jumps when it comes to CapEx spending?
Sure, I think dinged is quite a nice way to put what Meta went through on this. So there's a reason for this, and primarily it's because the market is spooked by what Meta's doing, because the strategy behind that increased and accelerated spending is a lot less clear-cut than it is for the likes of Microsoft in particular. So, for example, the path to monetization from AI for Microsoft is a lot clearer than it is for Meta. And there simply isn't the tried and tested track record. It's more of a leap of faith, saying, look, I've got the right ideas and this spending is going to pay off. It's a leap of faith, whereas the likes of Microsoft have got a clear track record of already pulling it off. So that's why the market is a lot jumpier around Meta's plans.
All right, Ryan, coming back over to you. You already kind of mentioned this, but you believe that PCE is going to be cooler than expected. You're believing there's going to be a positive surprise here. How do the markets react, though, in your mind? I mean, is this, again, a market-moving economic report, or has this already been kind of figured out that it's going to take a few more of these for the Fed to make a definitive decision?
Great point. It's going to take a few more positive inflation data points. So we haven't had too many yet. Let's be very clear. But yeah, we absolutely could see a little bit of a pop, I think, if inflation, after yesterday's worry, when everyone looked a little deeper into that quarterly PCE number. But again, look at what's going on, right? We've got unit labor production quite low. You've got high productivity. We know wages are strong, but comfortably coming back down. So again, there's parts of inflation that we all know are being stickier, specifically the shelter. People have talked about that out on this network, including myself, for a while now. So it's not a perfect scenario, but we're still optimistic, Frank, that we're going to have, maybe 2 cuts this year. And I know not many people thought that, but again, 3 months ago, when everybody's saying 7 cuts, we were saying, well, the economy's stronger. We might see more like 3 cuts. So now we think the pendulum has swung way too far, where we're saying no cuts, maybe a hike. And again, we'll see more with the inflation data. Yeah, go ahead.
Well, Ryan, I want to jump in. So your forecast is 2 cuts. I mean, some people believe there may be 0. In your mind, is it important that we get 2 cuts, or just the Fed indicates that we get cuts to keep the rally going? Obviously, we've seen a big pullback in the markets in the last couple of weeks.
Yeah, and again, the big pullbacks, why have they happened? I mean, we've had a huge rally, so it could be any reason. But I think just as long as the Fed continues to give a clue that, again, they're not going to hike, the hiking cycle's done, which they have. Honestly, that's what they've given. So again, the inflation data matters. At the end of the day, though, why have we seen less potential cuts this year? Because the economy is strong and overall earnings growth continue to impress, and we continue to see higher earnings growth going 12 months out. Those are the things that truly matter. And consumption, we're still making 200,000 to 300,000 jobs every month, last I checked as well. So there's still positives, Frank. We're still overweight equities. Maybe once we get through this little kind of seasonal potential lull, we can get a summer surprise rally, which again, you tend to see a lot in election years. One final comment: selling may go away. We're all going to hear about it next year. Just know this: those worst 6 months of the year are really strong in election years.
All right, Sophie, I'm going to give you the last word right now. Ryan believes we could see 2 cuts this year. We have seen the Magnificent Seven mega cap trade kind of break down since Jay Powell said that rates are going to stay higher for as long as they're needed. Is this PCE report, is it important when we're talking about mega cap tech and investor confidence in it? Because for some reason, investors seem to have kind of turned their back on tech as we've seen the rate cut path become less clear.
Yes, it is very important because it speaks to this fact that actually where we're at with inflation now, as much as it's very much moving in the right direction, these last few points of inflation are incredibly sticky. And I know we're all sick of hearing that word, but essentially what we know is that all of the spending that can possibly be pulled out of the economy has already happened, meaning that what is left is incredibly entrenched. And that is problematic. And that is why we are now seeing heightened nerves. So yes, it does matter to mega cap tech in a big way. We don't want to see interest rates really protracted or overly protracted. However, as I was kind of alluding to earlier, really at the moment, what is going to move the dial even more are those comments on AI and outlook and who's going to win this very interesting race that we're in the middle of at the moment.